Hello, it's Thursday the 17th. I'm FxPlew and this is the market brief. So Jeremy Hunt was on. He delivered his first budget yesterday. As expected, it was a pretty low-key and borderline boring budget, but his inner narcissist would still have been a bit miffed to be bumped from so many headlines by Credit Suisse. So yeah, another day, another mess from the banking sector. Credit Suisse reported a loss for 2022, which was no great surprise because they have been struggling to keep hold of their clients after a pretty impressive list of scandals. They've pretty much done it all: corporate espionage, fraud, breach of sanctions, money laundering, of course, and the old classic cliche for a Swiss bank, tax evasion. But you know the drill. They pay a fine, they fire some bad actors, and they get back to business of being too big to fail. Concerns kicked in yesterday though when their largest shareholder, Saudi National Bank, was unable to stump up any more cash due to regulatory restrictions preventing them from holding more than 10%. That sent the share price tumbling. It dropped about 30% yesterday, and that undermined any degree of fragile confidence that had returned to the banking sector after Silicon Valley Bank. Overnight though, Credit Suisse has secured significant funding from the Swiss National Bank. Apparently they took a €54 billion loan, and apparently they had to make a pinky promise that none of that money would be involved in money laundering. But apparently they had their fingers crossed when they shook on that one. So we'll have to see how that pans out. All these fun and games have rather tempered rate hike expectations, and the market had a pretty radical rethink over the global interest rate outlook. Money markets were pricing in a 50 basis point hike by the ECB. That was at 90%, but it's now less than 20%. Thoughts on the MPC remain pretty divided over the size of the next rate hike, or indeed if there should be one at all. And then over in the US, while the Treasury and the Fed continue to deal with the fallout from Silicon Valley Bank, expectations to a return of a more aggressive rate hike from the Fed have been shredded by all this turmoil. In the market, there was a risk aversion rally as money moved into the safe haven of the dollar. The dollar index rose to about 105.10. In the short term, we can expect jobs and inflation data to be replaced by news from the financial sector and adjusting risk appetite. So that means we can expect a degree more volatility ahead of the Fed meeting next week. Hold on to your hats.
If you do not have a clue, then just tweet through and ask FxPlew.